Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
Buenos dias. This week we're going to have a look at the latest outcome from our Global Asset Allocation Committee. We'll also have a look at what's happening to global inflation. We'll have a look at what's happening to global growth. And finally, we'll have a look at a key leading indicator for the Chinese economy. As a starting point, I'm going to be at the World Economic Forum in Davos this week. We'll provide feedback on that in time. A colleague of mine, Osama Zwai, will be presenting Macro Monday next week. We're going to start off with the latest from our Global Asset Allocation Committee. That committee met last week. There were a couple of changes to asset allocation. We've retained our underweight in US equities. There are a number of tailwinds for the US market. Earnings growth is pretty good. GDP growth is pretty good too. But we do feel that that market is still priced for perfection with a forward PE ratio of above 22. And as a result, we're comfortable remaining underweight. In addition, the key call from the committee is that we expect that the dollar will continue to weaken. It's weakened substantially over the past year, given the deficit in the US, the debt problems, and the potential for higher inflation in the US. We expect that the dollar will likely continue to weaken off levels that are still pretty strong by historical standards. And should it be the case that the dollar weakens, typically rest of world equities would outperform the US. We saw that last year. We think we're going to see that again. And we've increased our allocation to Japanese equities. The Japanese market doesn't screen as particularly cheap, but we do think that there are a number of tailwinds developing for that market, which should see still outsized returns, especially should it be the case that the dollar does continue to weaken. As an example, there's a number of corporate reforms currently underway. There's also a stimulus that's likely to occur as well. Wage growth continues to be strong, so we do see some potential upside in Japanese equities. We've also increased our allocation to emerging market equities on the back of an expectation that the dollar will weaken. We've also increased our allocation to Japanese fixed income, government fixed income, shifting away from an underweight. Bond yields in Japan have increased quite materially, and we see limited potential for losses there over the near term. We reduced our allocation to investment-grade credit. Investment-grade credit spreads are pretty narrow, and we're expecting an increase in issuance over the coming year, linked to increased demand for capital in the AI space. And as a result of that increased issuance, we expect that credit spreads will likely widen. We retained an overweight in gold. Gold has done very well over the past couple of years, but there's a shortage of safe haven assets at the moment across the globe. And we think that we're still going to continue to see strong central bank demand for gold. So in a nutshell, those are the changes that we're implementing across our business. In effect, it's a view that the dollar will continue to weaken, but implicit in that is a view that active management will likely do well over the coming year.
We hope you're finding this podcast valuable. If you are, please take a moment to rate Investec Focus Radio SA on your podcast platform. And to make sure you don't miss an episode, please remember to follow us.
Let's get into some of the other details that have changed over the past week. As a starting point, the latest PMI data has come out across the globe. This is monthly data. The latest number at 52 is a second consecutive decline, and that does suggest that global growth is starting to slow. That decline wasn't simply due to decline in the US, it was pretty widespread. We saw declines in Europe, in China, and in the US. So while the PMI numbers are still above 50 and global growth is likely still positive, the latest data does suggest that it is slowing relative to where it was a couple of months ago. There was some good news in the PMI data. If you look at the ISM Services Prices Paid series, which is a key leading indicator for US inflation, it declined again. It's still at a pretty elevated level, but it does suggest that inflation in the US will decline off current elevated levels over the coming 3 to 4 months. And we're going to come back to US inflation shortly. If we look at global inflation, of the largest 50 economies across the globe, 35 have reported inflation for last month. Median inflation is 2.5%. It's been 2.5% for 3 months in a row now. And what's interesting is that the dispersion of inflation rates across the globe is the lowest in about 8 years. So we're seeing a convergence of inflation across the globe at 2.5%, which is a level that's probably uncomfortable for most central banks. And one of those central banks is the US. If you look at US inflation, it came out at 2.7%, in line with expectations, but still well above the 2% target of the central bank. They target a different measure of inflation, but it's the same sort of idea. An inflation rate of 2.7 would not be particularly encouraging. What's concerning with regards to US inflation is that month-on-month inflation needs to be around 0 for year-on-year inflation to get to 2% within the next 3 months or so. So even though that ISM Services Prices Paid series suggests that month-on-month inflation may come down, it's currently at 0.3%. And if it drops to 0.2 or 0.1, that's not going to be enough to get US inflation to 2% within the next 3 to 5 months. And as a result, US inflation is likely to be above 2% for the foreseeable future, which means that the Fed is going to be facing some pretty tricky trade-offs over the coming year. And no doubt that's going to be a key talking point at Davos. And just finally, on China, the latest Chinese total social finance numbers came out last week. This is a key leading indicator for the Chinese economy. It's down again. It's been down for a couple of months now. And typically this suggests that Chinese growth is likely to soften over the coming 9 months or so. And this suggests that there is a need, and there's still ample scope given how low Chinese inflation is, for stimulus in the Chinese economy. And we're expecting an announcement soon. If we don't get that announcement, we're likely going to be revising down our forecast for Chinese growth, and as a result, probably revising down our expectation for commodity demand. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.